Below is a complete chapter-by-chapter summary of George Soros, The New Paradigm for Financial Markets, 2008. I keep the focus on the conceptual framework, reflexivity, the mechanics of the credit crisis, and Soros's interpretation of boom-bust dynamics. Chapter-by-chapter summary. The New Paradigm for Financial Markets. George Soros, 2008. Preface. Soros states that the 2008 crisis is not just another cycle, but the end of a super bubble that has been expanding for decades. The core thesis: financial markets are not self-correcting. They are driven by reflexivity, the two-way feedback between perception and reality. Part 1. Theoretical Framework. Chapter 1. The Concept of Reflexivity. Soros introduces reflexivity, a concept where market participants act on perceptions, not perfect knowledge. Their actions alter the fundamentals they are trying to predict. Example: if investors believe house prices will rise, they buy more houses, causing prices to rise, reinforcing the belief. This creates self-reinforcing, boom, and self-defeating bust loops. Chapter 2. How reflexivity differs from classical economics. Soros critiques mainstream economics. Markets are typically modeled as efficient and self-adjusting. Soros argues the opposite. Markets are inherently unstable. He introduces cognitive function, how people understand the world; manipulative function, how their actions change the world. These two interact in cycles and cause imbalances, not equilibrium. Chapter 3. Theories of bubbles and super bubbles. Soros distinguishes regular bubbles, short-term boom-bust cycles, e.g., tech bubble; super bubble, a long-term belief system embedded into society. The super bubble since the 1980s was based on 1. Market fundamentalism, 2. Deregulation, 3. Reliance on credit expansion, 4. Assumption that markets can self-correct. This belief distorted policy decisions and risk management for decades. Chapter 4. How credit fuels reflexive cycles. Soros explains why credit amplifies reflexivity. Lending decisions are based on expectations. Rising asset prices improve collateral, enabling even more lending. This creates leverage-driven booms. When prices fall, collateral deteriorates, triggering forced deleveraging, accelerating crashes. He claims the modern financial system, post-1970s, became structurally prone to such cycles. Part 2. The 2008 Crisis Analysis. Chapter 5. Origin of the Housing Bubble. Key drivers: ultra-low interest rates post-2001 recession, excess global liquidity, China, emerging markets recycling dollars. Government encouragement of home ownership, mortgage securitization enabling banks to offload risk, ratings agencies mispricing risk. Feedback loop. 1. Belief: housing never drops nationwide. 2. Banks loosened lending standards. 3. Homebuyers speculated. 4. Prices rose. 5. Institutions created leveraged mortgage products. 6. The bubble became systemic. This is a textbook reflexive boom. Chapter 6. The Unraveling. Soros describes the reversals starting in 2006. Housing supply exceeded demand. Subprime defaults rose. CDO and MBS valuations collapsed. Institutions with leveraged balance sheets became insolvent. The feedback loop reversed. Falling prices, reduced collateral, margin calls, forced liquidation, even lower prices. This produced a self-reinforcing bust. Chapter 7. Why it became a global crisis. Soros describes how interconnected financial institutions used hidden leverage, repos, SEVs, off-balance sheet vehicles, were dependent on short-term funding, spread losses internationally through complex derivatives. The crisis was not about subprime alone, it was the collapse of the super bubble ideology. Chapter 8. Reflexivity in action. Systemic failures. He highlights the ratings agency's inability to model nonlinear risk, regulators assuming banks could self-regulate, overconfidence in VAR models, procyclicality of Basel capital rules, moral hazard from the Greenspan put, the reflexive feedback between investor expectations, regulatory assumptions, market behavior became unstable. 3. Policy, future, and implications. Chapter 9. Why market fundamentalism failed. Soros argues the belief that markets are always right is a false ideology. Policymakers adopted it, leading to decades of deregulation. The super bubble burst because the ideology itself was flawed. Chapter 10. What governments must do. Recommendations. 1. Re-regulate the financial sector. 2. Recognize systemic risk, not just institution by institution risk. 3. Increase capital and liquidity buffers. 4. Manage rather than ignore asset bubbles. 5. Strengthen oversight of derivatives and shadow banking. He proposes a credit creation framework to monitor leverage and risk cycles. Chapter 11. Long-term consequences. Soros predicts lower long-term growth, a prolonged period of deleveraging, a shift towards stronger regulation, decline of the U.S. dollar's dominance, waves of political instability tied to economic stress. He was early to forecast the multipolar financial world we see today. Chapter 12. The future of reflexivity theory. Soros closes by asserting that reflexivity should be recognized as a core principle of economics. Markets should be managed with humility, not ideology. Crises will recur unless policymakers understand how feedback loops work. Executive summary, short version. Soros's core argument: the 2008 crisis was not a random shock. It was the inevitable result of a 30-year global superbubble created by the mistaken belief that markets are self-correcting. Instead, markets are reflexive. Perceptions influence reality. Reality influences perceptions. Cycles intensify. The housing and credit bubbles were extreme cases of reflexive loops driven by leverage, deregulation, and flawed risk models. The collapse exposed deep systemic vulnerabilities and required a fundamental rethinking of economic theory and financial regulation. If you want, I can also provide a diagram of Soros's reflexivity cycle, a comparison between Soros's reflexivity and Minsky's financial instability hypothesis, a trading market strategy interpretation of Soros's ideas, how he applies them in real trading. Just let me know.